Good morning and welcome to the Takeaways podcast. On today's episode, we are talking about angel investing, where the opportunities and the challenges are. And to help me to have this conversation, I'm with Thaheer, who is the director of the Africa Angel Guild. So he's going to be telling us more about what they do there and what's the current state of the angel investing on the continent. Good morning and welcome to the podcast. How are you doing, Thaheer?
Hi, Ephraim. No, I'm good. Lovely to be here. We're doing well. The sun is out here in South Africa today, which is a blessing because it's been really cold. So we're just happy to be here and to be alive and to be witnessing a lot of changes happening in the ecosystem right now.
So to start with, please tell me more about the Africa Angels Guild and what your mandate is.
Yeah, man. I'll maybe start with kind of like how it was birthed. There's a bit of a journey. And then I'll sort of talk about the mandate and that sort of thing. So I had been very focused. A lot of people know me for, the deep tech venture capital work that I've done. And so, having just been in that very focused mandate and bracket for a long time, I started noticing like I was passing up on some really strong opportunities, and so I started actually angel investing, trying to say like, I'm seeing a lot of interesting opportunities that I can't bring to the fund side. So how about I start angel investing to start jumping into those things? And then that journey sort of evolved. There was an interesting deal that I wanted to do. I didn't have enough capital on hand to meet sort of the minimum requirements that founding team was looking for. So I went to some of the angel investors that I know. And I said, hey, do you want to band together and we actually do this? So we set up an SPV, we did it, we got in the company. The company's actually been doing really well. So I'm super excited about that. And then we sort of looked at each other and we said, guys, we kind of did this in less than a month. We have been doing our own thing, but we work really well together and we know each other. So let's look at forming an actual syndicate. And so that's kind of how we birthed it. It was a process, because we started with our values and our vision and our mission. We went through all like exit scenarios. We went through what our potential investment policies and processes look like. We went through all of that before we actually, registered our structures and did that sort of thing. So we took like the governance and, that side of it quite seriously. And then what we did is we just packed all of our learnings into our investment philosophy, which is, informs our mandate as well, which is like we like to see companies that have an African theme to it. So either there's diaspora, they're building a business case in Africa, or it's founded here, that sort of thing. And then the company needs to have progressed to a point where they've already gotten their first set of customers, right? It doesn't have to be, like thousands of customers kind of a thing. We actually don't look at that too much at that early stage. We just want to know that somebody is willing to buy your goods and services. And our logic behind that is there's a lot of pivots, plot twists, fights and those sorts of things that happen even before you develop a product, right? And there might be some lawyer fights and, other things that happen in the background. And then you overcome all of that. And it's a tough journey. And now you finally hit market and somebody's willing to pay for your good and service, right? And they're willing to pay a particular price point. Now you've got somebody paying at a particular price point and you're looking back at your business and you're saying, well, these are all the assumptions that I had, but this is what my customer is saying. And these are what my next few prospective customers are actually saying based on the traction that I now have with this other customer. So I need to now augment my product, solution, business, or strategy in a particular way so that I can have better product market fit and scale. And so that's the point that we want to come in at that point where you're like pivoting on the basis of market data coming from customers that are actually paying for your goods and services. So that's kind of like where we want to come in. So it's still quite early. We don't care about the sectors and that sort of thing. We don't really want to be investing in things that harm people or planet. And then we like to see impact. It's face value. We don't measure it. We're not sort of impact managers. We just want to know that we're investing in things that make sense socially, environmentally. And these are just a net positive coming out of the deals that we do. right next to the economic benefit that we see.
I want to start at the beginning of the cycle, right? I mean, as like angel investor, I mean, from the VC side, right? Like in terms of the deal flow, a VC fund can have like an accelerator which feeds to the fund, etc. As an angel investor, how do you source the deal flow, and what challenges and opportunities have you been, able to identify there?
That's an interesting question, right? So, like, I've been sort of blessed because of my work on the VC side, where I just literally still have opportunities coming to me constantly, and I just feed that back to the syndicate, right? So that's been quite interesting, and that might come from other angel syndicates, and might come from other investors, it might actually come from some of the ecosystem players. So the people running the accelerators and incubators, and some of the venture studios as well. They invite me to their demo days. They do those kinds of things. So we have a constant source of pipeline, and that's just me. There are others as well receiving the same sort of level of pipeline. A lot of the times, though, the deals that are referred are sort of given probably a little bit more priority and credence because it's from a trusted network who value sort of their reputation, and then maybe they're also looking to invest, or they have invested in that particular company already. So, they have a vested interest in making sure that, the company succeeds in some way. So we kind of sort of prioritize those, but we do look at things that come to us directly as well.
I want to get now, like in terms of the like investment itself. I mean, like investing at the angel stage, it means that like you're taking like a majority of the risk, right? How do you try to hedge that risk, right? And then like in terms of the equity, how do you try to calculate that? Because I'm looking at the fact that, for a VC fund, that if you have a portfolio of 10, you need like one home run to be able to return the particular fund, right? For like the angel invest, how does that work?
So there ain't no such thing as hedging, man. Just in the angel side, right? So like you're totally right. As a VC, you can do that, right? The whole point is to highlight, X number of companies that can be somewhere between 10 to 100X, who have the potential to do so if they perform according to, the projections and the plan that you laid out for them, right? And so it's high risk. So a lot of them require constant injections of capital to succeed. And if they don't get that, then that might hamper the ability to perform, but also this product market fit, all of those things. But it's high risk, right? And so when you do get those one or two outliers, the one returns the fund, and then the other one gives you your significant profit, that you then start bagging, putting in the wallet, in the Bitcoin account, I don't know, whatever you do with your money. So like that's what you're able to do, as a VC, as an angel. We are less interested in, at least from our perspective, we're less interested in all or nothing, which is why we've sort of specifically said we want to see the companies have that traction. We like to see like really balanced, strong teams, people who've done it before typically. And then what we do is we look at it and we say, it'll be nice if this thing gets 10 to 100 if it has that ability. But is this a realistic business that we can understand, that we can actually support by looking at the different markets? Because remember, we across several markets, right? On the continent and then abroad. And we're sort of saying, well, can we help accelerate what they're doing in those markets that we are in? And then we can turn around and say, okay, if they're not in our markets, do we have the ability to also sort of build the subsidiaries under license, or whatever the case is, for that particular investment opportunity? And that might be a different contract completely to the investment agreement, but knowing that possibility is there makes it more interesting for us. So we kind of tend to, as far as we can, try to be a little bit more involved in sort of the success of the business. But then we also don't have to wait for a 10x for it to make sense to us. Because remember, when you angel invest, it's your own capital, right? There's no other funder, that sort of thing that you have to answer for. You're sort of saying, this is the amount of money I put in. Am I comfortable at the, if there's an opportunity where there's a 3x exit, do I want to take that? Most of the time you'll probably say yes, 4x, 5x, it's great. But, I don't need to wait necessarily for a 10x. I have complete flexibility in terms of what I'd like to look for. So from that perspective, we don't have to only pick the companies that are going to do 10 to 100. We can pick the companies that we think are very stable, very realistic, but will give us a good 3x opportunity as well. Obviously, when we look at the companies, we don't say, oh, this is the 3x, we're going to invest in it. We say, okay, cool. Like, what's that minimum level of, or what's that range that we think we're likely to get? So, between the 10 and the 3, so if we think that realistically, if the business succeeds, it's only going to get a 3x as like a minimum, then it's potentially interesting. But as a VC, you don't want to necessarily say, if it's only going to get a 3x as a minimum, as a possibility, then I actually don't want to potentially invest in this. I need this to be 10 to 100 as a minimum or as a range. So I think like that's kind of the difference in terms of what we do. So it's not hedging, but we try to just be a little bit more focused in terms of how we do deals. But then we're also open to things that are still risky in terms of stage, but not necessarily risky in terms of the type of business and what it needs to get through to exit.
In terms of the management, I mean, again, like I'm going to compare it to like a VC fund. For like a VC fund, you find that obviously there's the LPs, and then like in terms of the fund, there's the management fee, right? How does it work like in a syndicate, in that obviously there is no like the LPs and like a particular fund? How does it work for like in terms of the management of the portfolio?
Yeah, so it's quite interesting. So usually with the syndicates, when they form, they'll have a resource. It's one of the actual angels, or depending on the model that they have, they've got somebody employed to do investor relations and pipeline management. It's usually concentrated around sort of one person around these syndicates. Yeah, I think that's probably as simple as it's going to get. I don't know anybody who's necessarily really built, or on the continent, a full stack like team that goes and then supports a portfolio. It's usually light touch. There are those that have, though, either they started as a angel syndicate, or they started as a accelerator sort of program or incubation program, and then built the syndicate around that, or they had the syndicate and then they built the acceleration program to then support the ventures that they were investing in. So that's another way that some of the angels are starting to, or the syndicates are starting to now offer more institutional support. There's a lot of like development that has gone into some of the angel syndicates now. Like you look at it 10 years ago, it wasn't what you're seeing now. There's a lot more activity, there's a lot more syndicates. And with that has become a lot more institutional rigor. There are people like me who've gone from VC into angel. So I took some of that institutional knowledge and that process, and put it into the angel syndicate. A lot of times you see it, the angel syndicate start with, or the investment journey starting with angel investing and then morphing into VC. Or sometimes even those founders that have exited well-performing businesses, then turning around and saying, I now want to invest because of the success that I have, and I also want to use my knowledge and capabilities to help support these companies. So they would also go and start, these programmatic offerings and those sorts of things to support the portfolio. And the cool thing about the programmatic offerings is that offering can be its own standalone entity that works sort of alongside the syndicate. So that entity on its own can be self-sustaining, and so in that way, you are still getting the support that you need to run portfolio management, on a programmatic or a large sort of portfolio scale, but not necessarily have all of that burden sitting on the angel syndicate.
For the the angel investors, like like a majority of them, like like in terms of the exits, they usually happen like at the secondary stage. As a syndicate, right? Like, how do you decide when to do the exit, like in terms of the secondaries, and how does that work, and what influences your decision?
So there's how our syndicate is structured, right? Is we've got our founding angels, which is the core group of angels, and this is phase one, really. We'll come back and talk about phase two when we enter phase two, but this is phase one, really. So there's us, right? So we sort of evaluate deals and we go through the process, and then we vote and we decide are we going to invest, who's going to invest. Then what we do is we then say, okay, cool, this is interesting enough. Do we want to broaden the pool, right? For, it might be a strategic reason, it might be just for a particular deal, it might be because we're just excited and we know somebody who might want to join, right? So then what we do is we create an SPV, and we sort of bring the other angels into that SPV, special purpose vehicle. So so that's just an entity or structure or something that we would form to house or facilitate our investment into an underlying investment opportunity. Now, once that deal is done and sorted, we then gather around, and as opportunities arise, there will be an offer that somebody will put to us, right? So we would then go back, and then we would say, okay, cool, these are the options. This is the narrative at the moment. So let's gather feedback, and we'll gather feedback. And then we sort of say, okay, now let's put this to a vote based on all the feedback and insights that we now have on whether we should accept this or whether we should reject it in its entirely, or we should go back with a counter proposition. So that's kind of how we would go about it. So we're not sort of tied down to saying we need to exit in a particular period with a particular multiple in mind. We just look at the deal, we look at the merits of it, we look at the IRR, so the internal rate of return, and we say, does this make sense? Could I have made more money holding my money in the bank or whatever else, putting it in some farm produce, I don't know, whatever it is again that you do with your money. So we kind of like stack it up and we say, is this a healthy enough return for the type of risk, for the stage of investment that we've done? Are we leaving any value on the table? And if we are we comfortable enough to take the money now and then focus on, whatever comes next? So that's kind of like the that we would go through, and some of the elements that we would consider.
Over the past, like a couple of conversations I've had, like with the VCs on the podcast, right? In terms of the exits, I mean, one thing that they've always pointed out is that you have to convince the founding team, current cap table, and then the acquirer also. Is this like the same challenge at the like angel stage, and how do you kind of try to deal with it? If a founder does not budge on, say, like evaluation, etc., how do you try to have that kind of conversation?
Yeah, it's an interesting point you're raising, because as an angel, you're typically taking a minority stake, so you don't have like all of the sway that you would with the VC. You haven't bought any special rights, that sort of thing. So it's kind of a negotiation and it's a discussion, right? So there's a lot of soft energy and soft power that you kind of bring to your conversations to try and influence. So a lot of it is around perspective and education, but a lot of it is also around the nature of that particular offer. So a lot of time the secondary offers, it's actually somebody wants to climb into a company. The company is really interesting. It's got high growth prospects, but they have a minimum ticket size, and the amount of capital available, if it only goes into new shares, is going to severely dilute, or not necessarily even severely. It's just going to cross a threshold that the founding team or maybe the other investors aren't happy with in terms of dilution. So what happens in that case is they said, okay, well, fine. They would say, okay, cool. We'll actually buy shares or some of the holdings from some of the investors or all of the investors on your cap table. And then at that point, it becomes a discussion with everybody who's got a say in having those discussions. So literally everybody who's signed onto the cap table. And there would typically be a vote around that. And then an agreement would be reached, and then that's how you would do it from there. As a small angel or an angel with a small position in a company, it's unless the company asks you for it, you're not necessarily going to go out and try to engineer an exit opportunity. You might do it if there's pressure from the rest of the angels that are exposed alongside of you in that deal. Then, as a syndicate, you might make the decision to go then start engaging, and you would strategize around how to engage based on stage of the company, who you could sell to, and who else is on the cap table. Like there's a lot that you like sort of go around and you strategize around that, and then you formulate like who you speak to first, second, third, fourth, and then hopefully you can bring some level of alignment, and then you move ahead from there.
If you had to advise, obviously you have experience both on the VC side and on the angel investment side. If you were to advise a founder who has an offer from a syndicate and a VC fund, when should they take the VC offer and when should they take the syndicate offer?
That's a good question. You got lots of good questions. So I've been in deals where, as a VC and as an angel, where we've co-invested. So you can take both depending on the context. Typically, you're taking both at a super early stage, or which is your pre-seed, or at a seed stage where there's some level of strategic value in those angels, and that's why. But typically, you also need to look at the type of business that you are, and you gotta be honest, So a lot of people say that, they want to go get VC funding. Somebody came to me the other day to buy a GP practice. I said, yeah, I'm looking for a venture capitalist to help me buy this GP practice. And that's an education thing, And I said to him, well, this is a different type of transaction. It's not venture capital, So you need to sort of understand the type of business that you're in and what kind of capital typically supports that kind of business, right? So you might be in a business that can be self-sustaining in 2 to 3 years, that will give investors an ROI that maybe you don't want to exit. That might be highly attractive for an angel, but it's probably not highly attractive for a VC because you'd want to exit. You want high growth, and the high growth companies are very rarely profitable at that early stage. And so, you got to think it from that perspective. The other part of it is it's also okay to travel on a journey in a business, right? And use angel capital to get where you need to do, get the market traction, really grow and understand your market with this new opportunity that you have even deeper than you've had before. And then make a sort of executive decision and say, well, okay, I'm ready to enter the VC track and I want to go and raise VC money now, right? Because when you raise the VC money, it's high growth, high pressure, high momentum, consistently 24/7. It's a train that you cannot get off of, right? It does not stop. So the minute you decide to take VC money, you need to know that you're a VC aligned business, and so then, that's when you just start shifting gears. That's the Formula One. So it's about being honest about the type of business you have. If you're an SME, it's very tempting to try and position and reposition for VC. Don't do that. Position for your customers, just be honest about the type of business that you have. There's literally, if you have a good opportunity on your hands, there is capital for your business, so it's not about panel beating something, square peg in a round hole. Don't do that, so there's that part of it. And it's difficult sometimes for founders, and I get it, when you haven't been through the journey before. And that's where advisors and these incubation programs and acceleration programs are highly, highly important, because they do start giving you that kind of feedback, market access about who is the best fit for your business or not.
I think if there's one, questionable thing that the VC boom in Africa has done, is that every founder now think they need a VC check to be able to build a company, right? And that's not always the case. A VC company is a very specific type of company, and I think it's important that our builders really, really know what you are getting yourself into once that term sheet comes and you sign it, right?
Yeah.
In terms of the syndicate, right, you invest both on the African startups companies and also on the international companies. If you were to compare the state of the angel investment both in Africa and in the other kind of the markets, where would you say we need to get better?
Good question again. So if I look at it, we've probably got well north of 110 angel investor networks on the continent. If you go onto ABAN site, I think you'll see they've got about 75 or so networks listed in sort of their federation as an organization, and then that covers around 5,000 investors or more. Now, there's a deal that we're doing. It's a European domicile company doing interesting business on the continent. They are raising And so what I've done is I've said, oh, well, interesting that it's European registered and that they're operating in Africa. Maybe I can make a bridge, between Europe and Africa in terms of investors. So, sure, we African investors and the other African investors on the cap table, but I wonder if a European registered company doing business in Africa is interesting enough to European base. So I went to another angel investment community. And you remember when I said that, 5,000 is kind of like what ABAN represents in terms of investors. I mean, these people have 2,500 in their one community. That's just one investor network. I've got my investment network, well, not mine, ours, that we started because we're a collective, and we sort of bring in on a deal by deal basis. So at a given deal, we could be 15 or we could be 30 or we could be X number of investors. I belong to another network that has about 300. They've capped it at 300 investors. They've been very selective, that I'm a part of. And that's a big network, right, on the continent. But overseas, they've got so much more, and there's so much more. And it's okay. They've had a head start. Where we are now is in a phase of we've got all of these angel networks popping up. I think we need to collaborate more, find out how we can have membership spread across different networks, share these opportunities more, because we need the power of many. And currently, the way our networks are operating is that we have the power of few. So we need the power of many. And a big part of this is also education, right? We need more people, more investors coming onto podcasts like yours, and trying to just educate, to show other investors or prospective investors what it's like to operate in the space. A lot of the times, because I do angel investor training as well, a lot of times people come to me and it's like they're interested, but they have no idea where, who, what, or how. And so you got to go through a journey of sort of structured education to get into a point where that they are comfortable and they understand what it's like. You don't have to be high net worth to actually be an angel investor. And this is the thing that a lot of people don't realize, and that's the power of syndicates. You turn that power of one into a power of a few, and then eventually it becomes a power of many. And then you can have influential sort of decisions and So I think if we can just band together a lot more, instead of having one annual conference where angel investors come together, can we not just literally do a lot more of these consistently on a monthly, or what's the other word? Fortnightly basis. We are starting to get reports coming out on angel investment activity as well. It'd be nice to have that become as comprehensive as some of these VC reports are looking, because with all of this information, it allows for more education and it allows for more confidence to be built in participating in the ecosystem as both venture capitalists, but then also as angel investors. And then I think one last hope and a prayer is if, a lot more African venture capitalists become a bit more open to the idea of doing secondaries to angel investors, right? So currently, as it stands, a lot of the deals that are sort of exiting at a secondary level, it's only happening at later stages from African VCs where they might, buy out the smaller investors. But when we look at overseas investors trying to invest into African tech companies, they'll come in really early if they're interested enough and do a secondary. It's a non-issue. So I think it's something that we need to overcome on our side as well. And maybe that's going to be a of volume. So as the venture ecosystem grows more and we have more funds, things become increasingly competitive, then maybe at that point we'll start to get more secondaries.
And also in terms of the secondaries, I mean it also it benefits the team itself, because in terms of the staff, there's the SOPs, etc. And then in terms of the founders, they can then be able to get a little bit of the liquidity, because if you've been building a company for 10 years, you dedicated your career to that. So it helps to be able to get a secondary sale, either say at the Series A, etc. So I think it benefits just beyond just the angels, right?
Yeah, 100%.
You stated that like at this point you don't really look at the sectors when you're doing like your investments, right? But like in terms of the opportunities, right? What are you paying attention to? Because obviously, like at the moment, there's like the AI craze that's going on, and then like there's like a fintech which has always been like quite a sector like in Africa. But like apart from those two, what other opportunities are you exploring?
We like B2B in general. I don't want to get specific into sectors or industries. We just like B2B in general. The founders are, I mean, or rather customers are less finicky. They're sort of predictable, and in a lot of cases, there's a lot of hegemony. That's kind of like all the same. And what you're able to do is if you can capture upstream, then it becomes easy for you to then base your growth opportunities of what happened or based on what's happening downstream. So you can still benefit from all the B2C solutions that comes out of your upstream B2B enablement. Instead of having to go and find all those individual like B2C customers, because I mean that's an interesting business. It's just not what we're trying to focus on at the moment. And then I think further to that, I would say things that generally enable infrastructure, the rails basically. So businesses that enable other businesses to be spawned off of those businesses. That's quite interesting. Yeah, so you'll find that in healthcare, you'll find that in finance, you'll find that in enterprise solutions. To a lesser degree, you'll find it in agriculture. Just a tough place, but it's good when you get in.
If there's a trend that I have like identified over the past few of the conversations I had, is that like a majority of the interest is going towards like a B2B, and I think like I had like a reason why like like a B2C startups don't get that much of the love is because like your customer acquisition costs are going to be like so extremely high as a B2C startup. So I think that's quite like an interesting way to look at it. But do you think that, okay, say for example like in fintech, right? If the purchasing power like in Africa, like it gets better, like it improves, do you think like investors are going to go back to look at like B2C startups?
I do think so. And that's a very interesting point, because like as you were talking, I was thinking about like the base that we have as a continent. Most countries on this continent, like if you look at the base, it's quite low. Like if you are poor in, it's quite low. And then we also have like highly unequal societies. So there's a very few people that have like insane amounts of wealth. And then, I mean, this is in most countries in the world, but it's about where the base lies, right? And the base is very low for us, which is where most of your mass market is then sitting. So if your mass market is sitting like on a super, super low base, it means you almost always, when you're doing B2C, you have to do low margin, high volume. And that is an expensive business to get into. They work out well when they work and they chug like machines, but to get there, like the amount of capital and headache that you have to burn through, and it takes time as well, right? And so all the while you're pumping money into these businesses that take a lot of time to actually grow. There are those businesses that are doing well. They get off the starting blocks quite early, and they're doing really well in terms of doing B2C, and they got good traction, good margins. But very soon after launching, they have to start looking at market expansion or product expansion, because they've now rapidly approaching the cap. And it's not like they're the only players operating within that target market. So there's only so much market share to go around for people. So for you to be attractive business that can continue growing and scaling, you have to like now either diversify or go into new markets. And then that's just more money very soon, right? Very quickly. So like those are kind of some of the challenges. And I think if, as you say, things do improve remarkably over the next like 20 to 30 years, then maybe things will shift around a little bit as well. But maybe some of these platform players that have launched, will actually start consolidating a bit more, and then we'll see a lot more opportunities coming out of maybe those platform players as consolidation and success starts to, snowball a lot more.
I think we should actually get like a couple of tips from the FCMG guys about how they managed to crack the B2C kind of model in Africa. Because, if you look at like your likes of like, like a ShopRite, etc., they have grown quite like incredibly well off the B2C kind of model, eh?
Yeah, but I mean, how many decades has ShopRite been around for? We're the new retailers from the last 5 years that are doing incredibly well, and new retailers. They almost don't exist, right? It's all but those that have managed to raise insane amounts of money for e-commerce, and then from e-commerce, they've said, okay, cool, it's now working, it's an engine, and then they went into brick and mortar retail, bricks and clicks, so they didn't go straight into sort of bricks and clicks, and then they had good backing, and but there's not a lot of founders who starting e-commerce necessarily have access to the networks that are going to allow them to pursue those opportunities, and that's the other challenge that we have.
As we close off our conversation, I want to get your view on the impact of the mentorship in like angel investment. I mean, like a majority of the angels are either people who have built like businesses and have an exit, or they are professionals who have achieved quite a bit in that particular profession. How does this alignment of skills contribute towards helping these portfolio companies to overcome challenges, either like in sales or like in marketing or like in GTM, etc.? How do they contribute towards that?
Immensely, right? So I have the privilege of being exposed to a particular company that I had some pretty experienced high net worth angels involved. And what was quite interesting to note in that particular company was that on the one point at one stage of the journey of this company, they needed marketing collateral, they needed a marketing strategy, and one of the angels was literally there operating de facto as the chief marketing officer, helping build all of this collateral, helping record all of the videos, there with customer interviews, like doing all of that, and really helped build them to a point, and then sort of phased out of doing that once the company was in a position to do it on its own, right? At another stage of that same company's journey, they started having to deal with a lot of human resource challenges, right? And so another angel who had significant experience in running large businesses was able to then step in and support, and like clockwork. It was so natural, and the founders themselves were learning from these interactions, so they were able to put new policies, processes, and service providers in place to then support, so that the challenges that they had, they could overcome quite easily in future, so they were building more institutional rigor and capacity in the organizations based off of those angels then stepping up and being a little bit more involved. And so this is why it's important to pick the right angels, right, as well. And the other part of that is, when a syndicate comes on board, and it's not just an individual angel, is that syndicate then can leverage the collective resources, the pool of resources within that syndicate who's done that deal to be able to support the company. And chances are your angels are going to want to do it because they put their own money in, and they're like, ain't no way I'm losing my money today. So, they're definitely going to come and step in. Well, I wouldn't say definitely, but more than likely going to step in when they see that the company needs that level of support.
I think it's incredible work that you and the team are doing. I mean, I think like without the, angel investor capital, and the mentorship, etc., it becomes so incredibly hard for founders to be able to go beyond just their, like ideas, being like a business, right? Like they need that kind of capital and the mentorship that's going to take an incredible amount of risks to back them, right? So like I congratulate you and the team on what you're doing, and I wish you, all the best in everything else that you'll be doing in the future.
No, thank you very much. I appreciate those words. I'm loving the evolution on your side. It's good to see the growth and the new level, the new chapter. So I appreciate that a lot, man. Thank you for having me on the platform. It's an honor.
Cheers, man. Enjoy the rest of your day, Thaheer.
Okay, thanks. Same to you.